Inflation is down. The Fed still needs to finish the job. The Consumer Price Index rose by only 3% during the past 12 months. President Biden is taking a victory lap, saying inflation has dropped for 12 months straight. That interpretation is debatable, given the variety of ways inflation is measured. Prices rose more in June than they had in May. But there's a clear enough downward trend that the Federal Reserve is already hearing calls to declare its own victory over inflation, rather than continue to raise interest rates until it achieves its stated goal of bringing the inflation rate down to 2%. Although the case for relenting is not frivolous, the Fed should stay the course. Even before the government released the latest inflation number, Mark Zandi, the chief economist at Moody's Analytics, asked, "Do we want to sacrifice the economy to the altar of the 2% inflation rate?" He suggested that a 3% inflation rate might be tolerable. We should give Zandi props for bringing to mind the closing line of William Jennings Bryan's 1896 protest against tight monetary policy, "You shall not crucify mankind upon a cross of gold." But Zandi's argument has more than rhetorical resonance going for it. The 2% goal is arbitrary. A stray remark by a New Zealand official is generally thought to have begun the chain of events that led to the goal becoming orthodoxy for central banks around the world. Zandi is right that relatively steady, predictable, and low inflation matters more than the exact target rate. A steady 3% inflation rate would even have some advantages over a lower one, such as raising nominal interest rates and thus giving central banks more room to maneuver. That's why 22 prominent economists wrote a letter to the Fed in 2017 urging it to consider a higher inflation target. And if we were designing a monetary policy from scratch, we might well pick a 3% target. But we're not. There's a history we have to consider. The Federal Reserve let inflation run out of control from the late 1960s through the early 1980s, and then painfully wrung that inflation out of the economy through interest rate hikes that led to double-digit unemployment. It drove inflation lower and eventually settled on the 2% goal, which was formally adopted in 2012 but has arguably been in place since 1995. The current inflationary episode is the most serious one we have endured since the recession of the early 1980s. The Fed was late to respond to it but has done so notwithstanding political pressure. Senator Elizabeth Warren, Democrat Massachusetts, said last year that Federal Reserve Chair Jerome H. Powell was trying to engineer a brutal recession. So far there is little evidence of brutality. The unemployment rate is 3.6%, lower than it was at any point from the presidency of Gerald Ford through that of Barack Obama and exactly where it was when the Fed started raising interest rates last year. The labor force participation rate among Americans in their prime working years has increased during this tightening cycle, making the low unemployment rate, which counts everyone who is actively looking for work, even more impressive. Tightening has led to far less economic damage than its critics, or even some of its supporters, predicted. For Powell and his colleagues to abandon the 2% goal now would be to signal that they will flinch even in the absence of pain. If they should err again, as they did in 2021 and 2022, and inflation again rises, they will then have placed themselves in a terrible position. Let's say inflation hits 5%. How much credibility would the Fed have in pledging to do what it takes to hit its new 3% goal? Speculation that it would settle for 4% would be widespread. To convince markets that the Fed really means what it says would then require extra tightening. The Fed would be left with the same painful choice it faced in the late 1970s, let inflation keep drifting higher, or stop it through, well, a brutal recession. The pressure on the Fed is going to increase. But it should stick with the 2% goal. Its job isn't done. Inflation is down. The Fed still needs to finish the job. The Consumer Price Index rose by only 3% during the past 12 months. President Biden is taking a victory lap, saying inflation has dropped for 12 months straight. That interpretation is debatable, given the variety of ways inflation is measured. Prices rose more in June than they had in May. But there's a clear enough Biden is quietly reversing Trump's sabotage of Obamacare. Slowly but surely, President Biden is repairing the U.S. healthcare system, reversing Trump-era sabotage and ensuring millions more Americans get access to affordable coverage. The latest of these efforts came on Friday, in a little-noticed but significant decision to protect Americans from junk health insurance. In 2017, Congress repeatedly tried and failed to repeal the Affordable Care Act. To casual observers, it might have looked like the end of the Republican fight to kill this life-saving, inequality-fighting, newly popular law. It wasn't. Over the next few years, President Donald Trump found new ways to sabotage the healthcare system and its protections for the most vulnerable Americans. Among the most insidious of these backdoor repeal measures, expanding, short-term, limited-duration health plans, i.e., attempting to trick Americans into plans that looked cheap but basically covered nothing. Short-term plans are theoretically intended as brief, stopgap coverage, say, to tide over a new college grad whose job doesn't start until the fall. They're relatively unregulated, they don't have to cover minimum care benefits guaranteed by Obamacare and other major legislation, for example. A 2018 analysis found that most don't cover maternity services, substance abuse care, or prescription drugs. These plans can also deny coverage for care of pre-existing conditions, even if the pre-existing condition in question hadn't yet been diagnosed at the time the person enrolled. People often don't realize they've bought a worthless product until it's too late, when they get hit by a bus, say, or are diagnosed with a brain tumor. Such loopholes might seem like no big deal until you find yourself falling through one. The Trump administration made sure more people did by allowing these allegedly short-term plans to last as long as 364 days, rather than the 3-month max that had been in place, and to be renewed for up to 3 years. This made them look a whole lot like regular plans. Plus, because short-term plans are mega profitable for insurers, brokers can get much larger commissions for steering hapless customers into them. So, many did. Exactly how many were lured by this policy change is unclear. The data is lousy, precisely because these products are so unregulated. A recent estimate from the Urban Institute ballparked the number of people enrolled in individual plans that are non-compliant with Obamacare protections at 2.5 million. The proliferation of short-term junk plans affects even consumers who don't get duped by them. That's because these cheaper plans disproportionately siphon healthier, i.e., lower cost, people out of the broader individual insurance marketplaces. People who have chronic conditions or otherwise know they will need more substantial coverage are more likely to stay in the regular marketplace pool, driving premiums there ever higher. Last week, however, the Biden administration announced a rollback of this Trump-era expansion of short-term health plans. In a proposed rule, Biden officials said those already in these skimpy Trump-blessed plans can continue in them, if they so choose. There were some hard lessons learned from the "if you like your plan you can keep